Welcome to another episode of the Me and Money podcast. Elliott, how's it going today?
It's going well, Matt. How are you doing?
Good, good. Enjoyed your trip to New York, right?
It was. It was a good relaxation trip. Lots of food, lots of walking. We walked 13 miles one day.
Nice. Wow, that's a lot. That's
Yeah,
more than I probably walked all week.
same actually for me.
All right. Well, what are we going to talk about today? What's top of mind?
Let's talk about brokerage accounts and the flexibility they provide.
Yeah, that sounds good. So, I know the past few episodes, right? We've talked about variety of investment accounts. So, I'm just going to flip it over to you, Elliott. Like, what is a brokerage account? Maybe what are some of the common misconceptions you hear when you're talking to your clients about this kind of stuff?
Yeah, I like to think about a brokerage account that's a retirement account, but with no tax advantage to it. And I know that sounds a little bit funny, but there's no sort of limit about the amount of money that you can put into it. You don't get any sort of tax deduction for it. You don't have to be above a certain or below a certain income. It's just an account where you can do general investing for general purposes. That's how
Yeah.
I like to think about it. How do you like to think about it?
Yeah, no, I think that sums it up really well. I don't usually label it as a retirement account with my clients. I know we work with, different age brackets, shall we say. But I usually frame this with my clients as like your along the way investment account. So, like you said, right, there's no tax advantages. You don't, either get a tax break this year in most cases. Stay tuned to the end for that plot twist. But it's one of those things where it does provide a lot of flexibility. Like you said, it's also one of those things where I know, especially right now where we sit, right, high yield savings accounts, and your general interest on those accounts is higher than it probably has been in the last 10 years, if not maybe 20. I don't know. But it's still one of those things where you need to outpace inflation, and typically no matter where your cash is parked, it's not going to do that, right? So that's usually how I'm framing this with my clients, that it's general investing for things you might want to do 10, 15, 20 years from now that may not be for retirement specifically, and maybe you want to change that time frame on a goal. So
Yeah. And I would add, unlike some retirement accounts, it's not a limited menu of investment options. You could pick anything out there, right? We talked about safe investments like CDs, treasury bills, exchange traded funds, mutual funds, bonds, stocks. You have everything available for you, so you can really tailor that to the time frame of when you're using it. So whether it's a 10-year time frame or a 20-year or a 30-year or potentially a legacy asset even.
Yeah, yeah, and I do think it's important though. While we talk about that, right? So you can have stocks and bonds and mutual funds, whatever you want in there. But there are some things that we need to be mindful of when we're using that, right? Because, like you said, there's no tax advantage. So
Yeah.
why don't we start there and talk about some of the things that maybe we should think about before deciding if this is for us or not.
Yeah. So the first thing that I would think about is you are going to pay some taxes along the way. I like to think about there's two levels of taxation with a brokerage account. There's taxes that you'll pay along the way, and then there's taxes when you make the sale. So talking about taxes when you make the sale, I think that's the easiest component. So we'll start with that, if that's okay.
Yeah.
So whatever money you put into it, better known as your cost basis. So let's say you put $100 into a brokerage account and you invest $100 into investment ABC. That becomes your cost basis. If that grows to say $200 in the future and you go to sell, and that is held longer than a year, you have what's called $100 long-term capital gains. And for a lot of people, they're going to pay 15% on that $100, so roughly $15 in taxes. And there are some situations where people can pay 0% or 20% on long-term capital gains. We're not going to go into the details on that. Just figure out what your capital gains bracket is, or we might have an episode at some point in the future on how the taxes work on that structure. So capital gains are super important to think about. But as we talked about, if your investment goes up $100 and you're paying, say, $15 in capital gains taxes at some point when you go to sell, that's not the end of the world, particularly for the flexibility that this provides.
Yeah, yeah. And I noticed there you put a lot of stress and emphasis on greater than 1 year, right? So what Elliott is getting at there is if you do not hold those investments for more than a year. So again, that same $200, right? $100 grows into $200 example. If you sell that, say, next week, right? Awesome return, right? Great if you're doubling in a week. Probably shouldn't be aiming to do that, but then you're going to have to pay your ordinary income tax rate on that. Those are short-term capital gains. And so just, again, be mindful of that, right? If you do have some better than expected, shall we say, intra-year returns that when you take that money that you are going to owe taxes on that. I think it's important to know that whether it's long-term or short-term, but especially be careful if you're doing that inside of a year and not trading too much as well to trigger those gains. So
Yeah, good point. Matt, do you want to talk a little bit about the taxation along the way?
yeah, so in like Elliott's saying, so there's going to be the trading, right, that can trigger those taxes along the way, but also as capital gain distributions or dividends are paid off of those things that you're holding inside of the account, those are going to be forced transactions in most cases. So you're not going to see it you will see it show up on your statement, right? Sometimes it'll be reinvested into a share or just paid out as a cash dividend, but you are going to get a Form 1099 at the end of the year that explains the interest, the dividends, and those capital gain distributions that come off of that. So it's kind of complicated when you get the tax form, but we'll get into that in a second. But is that what you're referring to, Elliott? I assume. Yeah. Yeah. So just be mindful of that. Again, depending on how big the account is, right? If it's only $10,000 to start, you're probably not going to have like a massive tax liability for that. But just know that you might owe a little bit. And that is one of those cases where even if your withholdings are correct and you've been on top of that, sometimes those can be a surprise at the end of the year. And you're going to ultimately have to figure out how to pay that tax somehow.
Definitely.
Yeah. Yeah, one other thing on that too, when you get that 1099, Elliott, do we want to talk a little bit about the difference between like qualified dividends and non-qualified? Do you want to take a swing at that one?
Yeah, so when we talk about qualified and non-qualified dividends, major difference in tax treatment. Qualified dividends are typically taxed at long-term capital gains rates. So for a lot of people, 15%. Non-qualified dividends are taxed at your ordinary income rate, which generally is higher than that 15%. And the thing to keep in mind here is a lot of times things like bond ETFs, for example, will spin off non-qualified dividends and be taxed at ordinary income. That's not necessarily a bad thing, depending on your portfolio structure and what's going on. It's just something to be aware of, that they're going to have a higher tax treatment. There's other investments out there that will also spin off non-qualified dividends, and you just need to be aware of the tax treatment of all of that.
Yeah, especially those foreign ones, right? That can spin off their own fund section with 199A, right? The foreign dividends, and that's a whole nother thing. But just know you're going to have some things that need to be on your tax return. So if you have like a wide variety or a well-diversified brokerage account, you're probably going to have to fill out a few more lines on your tax return. So just be aware of that.
Yeah.
Yeah. The one other thing that I want to talk about while we're on taxes, and that's where maybe the hook to come to the end of the episode is, especially in times of market volatility. And again, this isn't something that we're suggesting you do. It can get complicated, especially if you're trading several accounts and have a variety of things invested in similar holdings. But sometimes you can do what's called tax loss harvesting in these type of portfolios. So if it's just as if you had the gain, right? Any of those short-term or long-term transactions, but instead you have a loss, you can actually harvest those losses and use up to $3,000 per year to deduct, right? Not credit, but deduct against your taxable income. So that can be really helpful if you have a larger account and you have a higher income, to take those losses in a given year, sort of bank them up or pool them up and deduct that against your 35, 37% income bracket, and save like $1,000 a year in taxes if you do find yourself in that situation. Do you want to get a little bit more into maybe some pitfalls of that, Elliott? I know there's a couple of, it sounds like a great thing, right? Because we get to deduct, but it can create both short-term potentially and long-term problems. You want to dive in on that a bit?
I'll talk about that in a minute, but I do want to stress how beneficial tax loss harvesting can be for a lot of folks if they're not in that 0% capital gains bracket. Because as Matt alluded to, you can offset $3,000 of ordinary income and then future capital gains, whether it's in the current year or the future. And my running joke is capital gains expire when you do. So if you book some pretty significant capital gains, you may, for many, many years, not pay any capital gains taxes. I've worked with folks in the past where you're able to book enough that they're not paying it for a very long period of time. So I think that's just helpful to think about. Ordinary income is one component, but offsetting future capital gains, because at some point, probably you're going to take some withdrawals from this account and recognize some capital gains then.
Yeah, and it can also, if you're charitably inclined, you can take those losses now and deduct those against your income, and then eventually maybe just give away those stocks that have gone up a ton of value, and the charity's not going to pay any capital gains tax on those. Plus, you'll get a nice itemized deduction on your tax return then too. So it can be a really fun. I think it's a fun and well diversified way to handle taxes throughout your life, where you can get some benefits now and use those to be smart about how you take your taxes later on in life too.
Yeah. In terms of pitfalls, are you talking more about sort of wash sales and replacing investments and that sort of thing?
That and just like on the flip side of that, right? If you do need some of those funds later on down the road, you can have
Sure.
higher embedded capital gains in the future too.
Yeah. So the key things about tax loss harvesting, a lot of times when you sell an investment, you don't necessarily want to be out of the market. So a lot of times you'll replace it with a similar investment, but not identical. And that's not clearly defined by the IRS. So you can do some research about what that means. And I'm not going to go into too much detail about it because it's not clearly defined. But that's one thing to be aware of. And the fact that if you have some reinvested dividends that are automatically getting reinvested, or you're making automatic contributions, you don't want to necessarily buy that same fund 30 days before or 30 days after when you're doing this tax loss harvesting. So there's some very specific rules that I encourage you to look into and know very well, because otherwise, if you run afoul of that, you have a disallowed loss. Nothing to be overly worried about. You lose the loss and your cost basis gets stepped up by the amount that's lost there. So it's not a permanent, hey, I lost it and bad things are happening or the IRS is coming after me. It's just going to increase the cost basis. So when you go to sell it later, you'll have less of a gain.
Yeah. Yeah. And so essentially what Elliott's saying is if you own company ABC and you just lost $100 on it, you can't sell it, realize that loss, deduct it on your tax return, and then go buy ABC the same day. As of right now, crypto does not function that way according to the IRS. So if you have big crypto losses, highly recommend talking to your CPA about how to maybe lock in some of those losses. But again, just to go down the example of Elliott, like if your company ABC is down $100 and you sell it and realize that loss and then go buy XYZ company, then you can stay invested and realize those losses. So that's a big one. I also, Elliott, want to hit on the embedded gains. And this is something I typically see being an issue for people who have a shorter term time horizon on these funds. So again, in that example, right, if we're taking the losses, now we have what Elliott referred to as cost basis, or your contribution is going to be lower, right? Because you just sold some, have less money, and you're buying back into whatever. If that thing then goes back up to, let's say, $200, now you have a lot more capital gains to deal with. And if you were planning on using that money in the next 5 to 10 years, you may still be working. You may still have higher capital gains rates. You may have more of those capital gains rates, the higher one, and more dollars in that. And so you can run into some, shall we say, tax problems or constriction in how you realize those taxes when the time comes. So it's kind of a nuanced situation, but just be mindful of that. Or hopefully you're not being too aggressive with anything you're going to need in the next year, but that can also be something where you run into more short-term capital gains, which is the exact opposite of what you want to do.
Yeah.
Yeah. Anything else you would add there, Elliot?
I don't think so.
Yeah. Sweet. Well, let's wrap up this one. Unless there's anything else, any final parting words of wisdom. And we're going to come back next episode and talk about more about who this might be a good account for. So we'll see you next time.
Sounds good.